Today, we're diving into a really interesting story from Singapore, Keong Hong Holdings. They're a big name in construction and property, and after a pretty rough patch, their latest financials show what looks like a massive comeback. So, the big question is, how on earth did they do it, and what's next for them?
And this number right here, this is the headline, 10.2 million Singapore dollars. That's the net profit Keong Hong pulled in for their 2025 financial year, after being deep in the red just the year before. It's a huge swing, and we're going to unpack exactly how they made it happen.
All right, so here's our game plan. We'll start with the big comeback story, then we'll really get into the numbers. After that, we'll break down their different businesses, and finally, we'll take a look at what the future might hold.
Okay, let's get right into it. This whole journey from making a loss to turning a major profit is the core of the story, so let's jump straight to the data.
Okay, now take a look at this table because it tells a fantastic story. You can see revenue went up, which is good, but it's not a massive jump. Now look at that gross profit line. It swung from a $5.4 million loss to a $13.3 million profit. That right there is a huge sign that they fixed something fundamental in their operations. And of course, it all flows down to that final number we saw, a net profit of $10.2 million. And this slide really just hammers the point home. I mean, look at that contrast. We're not talking about a small improvement here. This is a complete flip. To go from losing almost $4 million to making over $10 million in profit, all in 1 year, that is a serious achievement. So, the million-dollar question, or in this case, the $10 million question, is how? A turnaround this dramatic doesn't just happen by accident. It's a mix of things. So let's peel back the onion and see what really drove these numbers.
So, from an operations perspective, it really boils down to just being more efficient. First off, more of their big construction projects got further along so they could book more revenue. But here's the real kicker. Their cost of sales actually went down by 5%. How did they manage that? Well, they were finally wrapping up some really expensive projects that started before all the pandemic chaos, and they just got better and more productive on site. It's the perfect combo, earning more while spending less to do the work.
But wait, there's another half to this story. It's not just about what happened to the construction sites. The company got some serious help from financial tailwinds. Their other income shot up by over 50%. And this wasn't from building anything. This was stuff like getting a boost from a strong US dollar, selling more scrap steel, and even collecting more rent on their warehouses. On top of that, they slashed their borrowing costs by more than a quarter, just by paying down their debt. You add all of that up, and it's easy to see how that bottom line got so much healthier.
Now, it's super important to remember that Keong Hong isn't just one single business. It's made up of different parts, and they definitely did not all perform the same. Looking at this breakdown really shows you where their strength is and where their biggest headache is.
And wow, this chart makes it painfully clear. The building and construction side of the business was an absolute powerhouse, bringing in a profit of $17.2 million. But then you look at property development, and ouch, it lost almost $6 million. So think about that. The company's entire net profit, and then some, was generated by their core construction work.
And that core business? Well, looks like it's in great shape. This number, $203 million, is their construction order book. You can think of that as jobs they already have lined up and confirmed. It's a really healthy pipeline of future work for their main moneymaker.
And if we peek inside that order book, we see something pretty smart. It's split almost perfectly, 50-50, between commercial and residential projects. Now, why does that matter? It means they aren't putting all their eggs in one basket. If the market for new condos cools off, they still have office buildings and other commercial work to keep them busy. It's a great way to spread out the risk. But it is not all good news. And for anyone looking at this company, this is a big flashing yellow light. Their hotel investments in the Maldives are a real problem. The occupancy rate at their resorts is hovering just under 50%. The average for the industry there is over 58%. That is not a small gap. That's a significant underperformance that's dragging their results down. So you have to ask, why? Is it a marketing problem, a management issue? This is absolutely an area to watch very, very closely.
So, we've got a strong core business on one side and a clear challenge on the other. What does that mean for the future? Let's take a look at the road ahead for Keong Hong.
The company's interim CEO, Mr. Owen Shu, is sounding a pretty optimistic note here. He's basically saying the worst is over, and the plan is to lean into their main strength, construction, while also looking for new ways to grow. And you know what? That message lines up perfectly with the numbers we've just been looking at.
So let's lay it all out, the good and the bad. The big opportunity is that the demand for construction in Singapore is expected to stay really strong, especially with big government projects. But there are definitely risks. The housing market is slowing down, those Maldives hotels are still a problem, and this is a big one for investors, the company isn't paying a dividend this year. They're hanging on to their cash, which tells you they're being cautious and prioritizing a strong balance sheet over a quick payout.
And that really brings us to the final, critical question. Keong Hong has done an amazing job fixing its main construction business. That part is clear. But their real long-term success story will be written by whether or not they can fix their other struggling ventures, like those hotels, and turn them from liabilities into real, new engines for growth.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.